The growth engine mentor relationship is different from the income engine one in a few important ways. Understanding those differences before you start looking helps you know what to evaluate and what to prioritize. The most visible difference is intensity. The income engine demands active engagement every trading session. It produces results daily and generates real emotional pressure, which is why daily reinforcement from the mentor's content and community matters so much. But the growth engine is different. You're not placing trades every session. The activity is more episodic. But that doesn't mean that the mentor support drops to a monthly rhythm. A good growth engine mentor stays engaged on at least a weekly cadence. They provide regular content and community involvement that helps you make sense of what the market's doing and understand how current conditions affect your positions, and stay calm when things are moving in ways that feel uncomfortable. The psychological dimension of the growth engine is real and continuous, even when the trading decisions aren't. Markets move every day. Positions fluctuate between entry and expiry, and sometimes significantly. Early assignments can happen. A stock can be put to you before the expiry date, and that requires a covered call decision sooner than you'd planned. Weekly expirations can come into play too, particularly as a position management tool when monthly expiry creates a situation that needs adjusting. None of this is purely mechanical. All of it benefits from a mentor community that's actively engaged with what's happening each week, and not one that only shows up at expiry time. The single most important thing a growth engine mentor needs to teach you is how to select the right assets. For wheel strategy practitioners, that means choosing quality companies with liquid option markets, companies that you would be genuinely comfortable owning if the put is assigned and the position goes underwater for a while. For value investors, it means developing the analytical capability to assess intrinsic value well enough to distinguish a real bargain from a value trap. And for dividend investors, it means evaluating the safety and sustainability of the dividend and the underlying quality of the business behind it. In every case, selection is where most growth engine investors make their biggest mistakes, and where a good mentor has the greatest practical impact on your outcomes. A mentor who teaches strong execution mechanics but weak selection criteria will help you execute a flawed process efficiently. That's not an improvement. It's not very helpful. When you evaluate growth engine mentor candidates, you need to weigh the quality of their selection framework above everything else. The second thing they need to teach you is how to manage positions when they move against you. For wheel practitioners, that means having a specific plan for when an assigned stock falls significantly below your cost basis. This is not a vague intention to figure it out at the time. We're talking about a defined response. Do you continue selling covered calls and collecting premium? Do you consider selling more puts at lower strikes? Or has the original thesis for owning this company been invalidated and should be closed altogether? A mentor who's worked through these scenarios clearly is giving you something that you're definitely going to need. For value investors, the equivalent challenge is distinguishing between a stock that's down because the market is temporarily mispricing it, which might be an opportunity to hold or to add, and a stock that's down because your original assessment was wrong. These require different responses. A mentor who helps you build that judgment is teaching you something incredibly valuable. The third element, which is specific to wheel strategy and options-based approaches, is a complete grounding in the mechanics. Not just the basic setup of a put or a call, but how position value changes across different market conditions, what happens at assignment, and how to think about rolling a position, and for that matter, how the overall structure of the trade evolves from the opening all the way to the close. The wheel is more mechanically involved than it looks at the surface level. A mentor who covers the full range of situations, not just the clean textbook outcomes, but the whole range, they're preparing you for what the approach actually looks like in practice. When you run the 30-day evaluation for a growth engine mentor, the most revealing week is week 3, the community assessment week. For the income engine, emotional guidance shows up immediately during the live execution week because you're making real decisions under pressure. But for the growth engine, you assess it by watching how the mentor engages with their community during a period of market stress. Do they help members stay calm and systematic when positions are moving against them? Do they address early assignment situations with specific practical guidance? Do they help members distinguish between conditions that should genuinely change their view on a position and conditions that are simply noise to hold through? A mentor who only discusses position setup and expiry outcomes without supporting members through the in-between periods is not providing the full guidance that the growth engine requires. The style fit question also applies here, but with a different emphasis. For the growth engine, the most important dimension is the depth of the mentor's stock selection analysis. Some mentors treat selection as a quick numerical screen. A stock passes or fails based on a few criteria. But others go deeper: business quality, management, competitive positioning, conditions that would invalidate the thesis for owning the stock. And neither one of them is wrong. The depth that suits you depends on how you want to engage with the process. But knowing which kind you want makes it much easier for you to find the right mentor. And one more practical note on the growth engine evaluation timeline. Unlike the income engine, where setups can occur daily and you get fast feedback on whether the method's working in your hands, the growth engine operates on longer cycles. A single options expiry might be 4 weeks out. A single value investing thesis might take quarters, even years to play out. This means the 30-day trial will not give you the same density of feedback as an income engine trial. What it will give you is a clear sense of whether the method is specific enough to apply, and whether the community support is what it claims to be, and whether the psychological guidance that the mentor provides feels like it would sustain you through long stretches of waiting that the growth engine genuinely requires. The accumulation engine mentor relationship is the most different of the three. For the income engine, you're learning a specific repeatable method from one primary mentor. For the growth engine, you're learning a systematic approach with clear selection and management criteria. But the accumulation engine works differently. It's driven by a thesis construction and management focus. This is a process that draws on multiple sources of thinking rather than a single teachable method. This means the accumulation engine mentor layer looks less like a teacher-student relationship and more like a curated research infrastructure. You're not following one person's system. You're building your own thesis process by drawing on the best analytical thinking that you can find across the areas where you're investing, and then you're filtering it through your own judgment. The specific sources you follow for the accumulation engine depend entirely on where your theses are concentrated. If you're investing in technology and AI, let's say, you want analysts to understand the economics, the competitive dynamics, and the adoption curves well enough to distinguish durable opportunities from overhyped narratives. If your theses involve macro themes like energy transition or demographic change, you want macro analysts with a verifiable track record of identifying structural shifts over a meaningful time frame. If cryptocurrency is part of your accumulation engine, you want researchers who understand the specific protocols and the ecosystems that you're invested in, not just general crypto optimism. The evaluation criteria for accumulation engine sources are different from those for trading and investing mentors, but the underlying principle is the same. You're looking for demonstrated track records, verifiable reasoning, and content that develops your own judgment rather than creating an ongoing dependency. An analyst whose work you absorb and then use to inform your own thesis construction, that's serving you well. But one whose specific recommendations that you follow without understanding the reasoning, that's not helping you, because you'll not be able to tell whether the thesis is still intact or whether it's been broken by new information. That judgment is the most important thing that the accumulation engine requires. The rhythm of your engagement with accumulation engine sources is also different. Income engine mentor content is consumed regularly, often daily, because the method needs to be current and the feedback loop needs to be active. But accumulation engine research is consumed much more selectively. You're looking for specific analytical thinking about the areas where you have theses, not a continuous stream of general market commentary. The skill to develop over time is identifying which sources consistently produce original, reasoned analysis that actually improves your thinking, and disengaging from sources that produce volume without corresponding value. There is one more dimension that's worth calling out. As your accumulation engine positions mature, you'll encounter situations where the original thesis is challenged by new information. Maybe it's a regulatory change or a competitive development or a macro shift that affects the conditions that the thesis depends on. Deciding whether the thesis is broken or simply tested is one of the hardest calls that the accumulation engine requires. The research relationships that you've built over time are the primary resource for making those calls well. A macro analyst whose reasoning you've followed for years, whose process you understand deeply, and whose track record is verifiable is way more useful to you in that moment than any amount of fresh commentary from unfamiliar sources. So build those relationships early and maintain them consistently. The accumulation engine is also part of the virtual investing org, where patience in building the research infrastructure pays the most. The income engine mentor provides value immediately. You need the method to trade. The growth engine mentor provides value within the first expiry cycle. But the accumulation engine research infrastructure builds value slowly as your understanding of the analysts deepens and your confidence in their frameworks grows. Investors who start building that infrastructure early, even before significant capital is allocated to the accumulation engine, they're in a much better position to deploy that capital well when it arrives. Now, with all three engines covered, the virtual investing org is assembled. But assembling it is just the start, it's not the finish. The virtual investing org is a living structure that evolves alongside you. Managing it well over time is one of the core GM hat responsibilities, the thing that separates investors who keep developing from those who plateau after the initial setup. The management rhythm runs on 3 cycles: the monthly scorecard, the quarterly gap review, and the annual assessment, and each one has a different function. The monthly scorecard we covered in episode 8. At the end of every month, you fill in the results for each engine: opening balance, target, actual result, closing balance, and you note whether the process was followed correctly. The scorecard is not just a record of results, it's how you surfaced information about whether each engine's process is working the way it should. A month of below target income engine results prompts the question, was the method followed? A month of growth engine positions that underperformed prompts the question, is the selection process producing the quality that it should? The scorecard keeps both hats active. The operator hat, tracking whether execution was correct, and the GM hat, tracking whether the overall system is on the right trajectory. The quarterly gap review is where you return to the gap map. Every 3 months, ask 2 questions about each gap you've been working on. First, has it closed meaningfully? If a gap has not closed after a full quarter of serious engagement with a mentor's method, that's worth acting on. Either the engagement's not deep enough, or the mentor is not the right fit for this gap at your current level. And second, has working through this gap revealed a new one that you should now prioritize? Skill development is layered. Closing one gap often reveals a deeper or more specific gap underneath it. Staying current with your gap map keeps the virtual investing org development pointed at what actually matters. Now, the annual assessment is broader. Which mentors are still serving you well, and which have you outgrown? Are there areas in any engine where the guidance you've been using is no longer sufficient for where your skill level is now? Has your situation changed, such as having more capital available, or different time constraints, or new areas of knowledge? Has it changed in ways that could change how the virtual investing org is structured? The annual assessment is also the right time to review the support functions. Is your tax and corporate structure still appropriate for the scale the system's reached? One pattern worth calling out, because it's very common, is that the temptation to overload the virtual investing org with content sources is very real. Once you start building the mentor and research infrastructure, it's natural to add sources faster than you subtract them. For instance, a new trading mentor whose method looks interesting, or a macro analyst producing compelling content, or a cryptocurrency researcher whose newsletter seems high quality. But before long, you're consuming way more than you can meaningfully engage with. The quality of your engagement with each source drops as the number of sources rises. Managing this actively is part of the GM role. Every 6 months or so, audit what you're actively engaging with against what you're nominally subscribed to. If a source has not produced anything you've genuinely applied or been influenced by in the last 3 months, it's probably no longer serving you. The virtual investing org should be curated, not accumulated. Depth of engagement with a small number of high-quality sources beats breadth of coverage across a large number of reasonable ones. There's also a positive version of this rhythm that's worth building: the deliberate search for the next level. As your skill in each engine develops, the mentor who was ideal at the start becomes less useful. Their foundational content no longer teaches you anything new. Their community is no longer addressing the level of nuance that you're working at. But this is a success outcome, by the way. It means the mentorship has worked, but it requires you to actively look for the next level rather than just continue to engage with the content that you've already outgrown, but you're continuing with it out of habit. The annual assessment is the natural moment to ask for each engine, is this still the right mentor for where I am now? It's also worth being practical about what moving on from a mentor actually involves. There are no cancellation conversations or awkward endings. If a mentor's content is no longer serving you, you simply stop engaging with it and redirect that time toward content that does. The frictionless nature of these relationships is one of their genuine advantages over more formal advisory arrangements. You can upgrade, downgrade, or change direction with no cost beyond the time it takes to find the next right fit. The Virtual Investing Org is now complete in its design. You have the framework for all three engine mentor relationships, the tools to find and evaluate candidates, the 30-day trial process to test them in real conditions, and the management rhythm that keeps the Virtual Investing Org developing in the right direction over time. What you've built across Module 2 is not just a set of ideas about mentorship. It's a specific operational structure for how you develop the expertise to run the three-engine wealth system over multiple years. It's the Income Engine mentor who teaches you a replicable risk management trading method. It's the Growth Engine mentor whose selection and management framework helps you compound capital systematically. It's the Accumulation Engine research sources that sharpen your thesis construction process. And it's the tax professional who gets the structure right before the scale makes errors costly. All of it works together, and the GM hat keeps it pointed in the right direction. The final episode of Module 2 is about our own virtual investing org that we use for the $1 Million Experiment. We will walk through the decisions that we made for each engine, not which specific mentors we use, but the type of mentor we looked for, the criteria that we applied, and what the selection process revealed about what was right for our specific situation. It's the most concrete episode in the module. Before then, if you've not already started building your gap map and shortlist from episodes 11 and 12, now is a good time. The final episode works best when you're bringing your own specific situation to it. A working hypothesis about your income engine approach, a sense of your most pressing gaps, and a first set of mentor candidates in mind. The more concrete your brief, the more useful the $1 Million Experiments experience will be as a reference point. And one thing to take away from this episode before the final one. The Virtual Investing Org does not need to be fully assembled before you start. Trying to get it all in place before beginning will delay the start indefinitely, because the best information about what you need comes from running the system, not from anticipating what you'll need before you run it. Start with the Income Engine mentor. Begin the process. Let the experience tell you what gap to fill next. The system builds itself as you run it. The Virtual Investing Org develops alongside it. Both of them compound over time. Remember to like and subscribe so you don't miss the final episode of Module 2, and we'll see you there.